Don't we just love this forever battle between asset classes, which one's better, shares or property, ETFs, LICs, you name it, gold, all that kind of stuff. There's no one simple answer. Basically, I think it really just comes down to depends. But as a generic rule that I follow, and something that I learned from experienced investors, who's very wealthy today, one of the key lessons is OPM stands for other people's money. If you're able to leverage off other people's money, that's how you can grow exponentially. And what do I mean by OPM? So other people's money are like bank's money, for example. If you can leverage bank's money in order to boost your own wealth, that's OPM. That's using other people's money, not using your own resources, but using other people's money. So in this case, if you're able to leverage off other people's resources, then that's how you can excel, and that's how you can accumulate wealth in the longer run, rather than having to save up. Because think about it, it takes a long time to be able to save up, especially in Australia. It's a very expensive country to live in. So having spoken a little bit about OPM, let's think about how we can apply the concept of OPM into property or shares. So for property, you can think of it like this. If you're buying an investment property, you're chipping in about 20% of your own money as deposit, and you're borrowing about 80%. So you're only putting in that much yourself, whilst you can leverage off that much, the 80%. And that's one of the most powerful tools with property, is that you can leverage a lot, which other asset classes you can't. You simply can't take it to that level. And that's why it's such a powerful tool for property. And that's for one property. Imagine if you accumulate 3 or 4 properties and they all grow over the long period of time, they all grow exponentially, and that the compounding does its own magic. Then at the end of the day, you'll have a very good asset base, and if you sell a couple of those, pay off the debt, which means you only use 20% of your money, and you're able to leverage that 80% to be able to get to that next level. And that's why it's important to be able to, that's the pros of buying property, is to be able to leverage off that borrowing power, that OPM. In shares, you can also leverage a little bit, but nowhere near as close as 80%, of course. And shares are a lot more liquid as well, which means, you can actually sell that fairly quickly and trade off your cash. So it's a lot more liquidable asset in comparison with property, which means it will also fluctuate a lot more. So if you compare property and share prices, that's why property prices usually changes more slowly, where share prices in a day, they could go up and down like that. It's because of the liquidity between the two asset classes. Okay, so in between the OPM, property wins hands down with using other people's money, unless if you do have an equity line. Let's say, for example, you bought a property and you're able to take out some equity and use that equity towards buying shares, then yes, that's actually a good example of OPM. And that's why a lot of young people actually start off with property, because they got good leverage at that point in time to be able to get into property first. After a couple of years, once the property has some growth, then they essentially take the equity out, and then they either recycle the equity to be able to purchase another property, or they want to consider shares at that time as well. In that case, then they can also use the borrow money, the equity line, to fund against purchasing the share portfolio or the ETFs or the LICs. So there are options. So I really think that both the property and share asset classes are great asset classes, as long as you know what you want to get out of it. Personally, I think property, you want to aim for the maximum capital growth. So capital growth is what you should be aiming for, not for cash flow, more for capital growth. If you think about my story, the first couple that I bought are basically capital growth. So I was able to get the equity line out, and then I can purchase more property. And at that point in time, when I want to expand, that's when I start leveraging more into kind of yield property, because it will be easier as your portfolio grows. You also need to consider from risk perspective. That's why I started purchasing a bit more yield property, to be able to make it easier to hold for a bigger portfolio. But I started off with growth, and that is what you should be aiming for in purchasing your first, second, third investment property. You want to get that capital growth. For shares, it's all about cash flow. So you want to be able to get that dividend, get paid to you every year, because, one of the beauty about shares is that, if it's a dividend, it's constant. You don't have the issue of you're not going to get the dividend. Not like property, where if the tenant goes out, then you lose the rent, and you actually had to fork out, your own pocket money to be able to pay off the mortgage. So that's some slight differences between each asset. I would suggest buy property for growth, for capital growth, buy shares for cash flow. That's my thinking behind these two asset classes. Hope it helps, and hopes it gives you a little glimpse in between the two asset classes, property or shares. Again, it's generic advice today. It usually depends on your specific circumstances, and I would suggest you seek specific advice with a financial planner to determine the best solution in your situation. Hope you like this video. If you do like it and find it helpful, give us a thumbs up, subscribe to our channel. If you got any questions, feel free to comment below. I'll be more than happy to answer, or simply email me at david@empower.com.au. Otherwise, I will see you again in next week's Invest Power episode.